Okay, let's jump right into this high-stakes explainer. Today, we're tracking the intense, multi-front battle that is absolutely defining the cryptocurrency market as of August 17th, 2026. What we're witnessing right now is a massive standoff. On one side, we have unprecedented security breaches hitting the ecosystem, and on the other, fierce regulatory and macroeconomic headwinds pushing back hard. It's a market essentially trapped in a range, waiting for a catalyst. And to be honest, the underlying structure is incredibly fragile right now. So let's break down exactly how this is all playing out. We have to start with a devastating blow to the market's core defense, which is cold storage. A staggering $116 million in Bitcoin has just been drained in a massive hardware exploit. Now, you need to understand, this wasn't your typical hot wallet hack or some exchange getting compromised. Over 1,800 Bitcoin were siphoned directly from addresses linked to CoinKite's Coldcard hardware wallets. These are devices explicitly designed to be entirely disconnected from the internet. Their whole purpose is to keep your private keys absolutely safe. So when the ultimate fortress gets breached like this, it sends a massive shockwave of fear straight through the entire self-custody ecosystem. And here's the crazy part. This wasn't a sudden, highly sophisticated online attack. It was actually a sleeping threat that awakened from a 5-year-old firmware bug. Look at this timeline. Back in March 2021, a firmware update silently disabled the device's true hardware random number generator. Fast forward to July 30, 2026, and the first major wave of thefts hits the blockchain in just a matter of minutes. As of today, August 17th, over 5,200 addresses are confirmed compromised. For half a decade, users were locking their digital wealth inside vaults that fundamentally lacked a secure lock. So what actually went wrong? The mechanics of this failure come down to a seemingly dull but literally fatal MicroPython code error, MicroPy HW enable RNG set to 0. Because of this one single error, the wallet bypassed the secure hardware generation entirely and defaulted to a weak software alternative. Instead of generating a virtually uncrackable 128-bit entropy seed, it spit out a highly vulnerable 40-bit seed. To put that into perspective, using a 40-bit seed to guard your digital wealth is kind of like securing a massive bank vault with a cheap diary lock. And here is why this is so terrifying for users. This specific code error weakened the initial seed generation itself. A simple firmware update today won't fix a wallet that was more compromised. Like the security researchers noted, a bad birth certificate doesn't become clean just because you fix the printer. So, the absolutely crucial point here is how you protect yourself if you're caught in this blast radius. If your wallet seed was generated on an affected device between March 2021 and the recent patch, you cannot just update your firmware and assume you're good to go. You literally have to restore your shields from scratch. Step 1, update your device to the fixed firmware, like the MK4 version 5.6.0. Step 2, generate a completely fresh, mathematically secure seed phrase. And Step 3, transfer your funds to that new seed immediately. Do not wait around on this because hackers are actively scanning the chain for these weak 40-bit seeds right now.
And unfortunately, the security onslaught doesn't stop with CoinKite. Secondary fronts across the industry are being breached too. SafePal, which is another major hardware wallet provider, just disclosed a vulnerability that exposed the names, addresses, and order details of nearly 40,000 users. And it gets even worse for centralized platforms. Bits of Gold, a major Israeli crypto broker, suffered a massive theft of KYC records, exposing 200,000 customers. Now, while these specific breaches didn't drain on-chain funds directly, they exposed thousands of users to highly targeted phishing and social engineering attacks. We are looking at a serious crisis of trust across the board.
All right, let's shift gears to Act 2, the macro battlefield, facing the headwinds. Because, you see, the crypto market isn't just fighting off hackers right now, it's also fighting a massive capital drain driven by broader macroeconomic conditions. Security breaches definitely create fear, but macro conditions dictate where the big money actually flows. Right now, traditional markets are absolutely soaring, with U.S. tech stocks and major indices like the S&P 500 and the Dow hitting all-time highs. Investors are naturally rotating their capital into traditional equities. Consumer confidence in the U.S. is a bit shaky, and when that happens, institutional and retail money tends to flock to the perceived safety and momentum of soaring stock markets. This is leaving Bitcoin struggling to capture any fresh demand. And this divide is literally playing out right under our noses in the ETF space. U.S. spot Bitcoin ETFs are bleeding heavily right now, posting a $390 million net outflow last week. That's their heaviest withdrawal in 6 weeks. But in sharp contrast, capital is surprisingly rotating into alternative assets. Solana ETFs are actually seeing their strongest weekly inflows since mid-May.
This tells us a lot. It shows that while institutional appetite for Bitcoin is definitely cooling off in the short term, investors aren't abandoning crypto entirely. They're just strategically rotating their capital to different layers of the ecosystem. Adding even more pressure on Bitcoin is a rapidly crumbling regulatory outlook. According to Galaxy Research, the odds of the Clarity Act passing in 2026 have completely plummeted. Back in May, the market was pricing in a highly confident 75% chance of this landmark regulatory framework becoming law. But today, those odds have crashed down to a mere 10%. Institutional capital hates uncertainty above all else, and watching the primary vehicle for crypto regulation stall out like this is keeping the big buyers firmly on the sidelines. The primary reason for this massive regulatory stall comes down to gridlock over some very specific provisions. Debate has centered entirely around proposed rules that would restrict Donald Trump and his family members from issuing tokens, which follows reports of their massive earnings from digital assets last year. This ongoing debate has essentially halted all legislative progress, keeping a heavy cloud of uncertainty hovering over the industry at least until the Senate returns from recess for a crucial cloture vote on September 15. So until then, the market is basically flying blind on the regulatory front. Which brings us to Act 3. The price standoff, holding the defensive line. So, taking all that into account, how are the assets themselves holding up against unprecedented hardware security failures on one side and capital rotation plus regulatory gridlock on the other? Looking at our big picture metrics, it's a market holding its breath. The overall global market cap is stubbornly holding the line at $2.16 trillion, which is virtually flat over the last 24 hours. But the sentiment gauge, the Fear and Greed Index, is firmly trapped in fear territory at just 38 out of 100. Interestingly, though, the Altcoin Season Index is showing a bit of a pulse, taking up to 46 out of 100, and that aligns perfectly with that capital rotation into Solana and other altcoins we were just talking about. Drilling down into our key battlefield defense levels, the major assets are completely boxed in. Bitcoin is hovering just above its critical support zone of 62,300, but it's trapped below a very heavy resistance ceiling at 64,000. It just cannot seem to break out. Ethereum is in a similar chokehold, fighting desperately to reclaim 1900 while leaning on support at 1800. What's fascinating is that ETH is struggling even though Vitalik Buterin just announced the massive Lean Ethereum roadmap. That's a huge 3 to 4 year protocol overhaul aiming to make the core smaller and easier to verify using recursive Starks, while also bringing in quantum resistance and native privacy. But even with major tech upgrades on the horizon, the macro gravity is just holding it down. Meanwhile, XRP is fiercely defending that psychological $1 line. We are in a classic consolidation phase.
But here is the critical vulnerability hidden inside all this sideways action. We are currently sitting right on top of a massive volatility trap. There is a towering $48 billion in notional open interest in the derivatives market right now. That's roughly 750,000 Bitcoin leveraged up in contracts. And yet, we're seeing incredibly thin trading liquidity across the spot exchanges. The market depth simply isn't there to actually support this massive tower of leverage.
This mismatch, this is exactly what keeps traders wide awake at night. What this means for anyone trading right now is that if a sudden macroeconomic catalyst drops, or maybe another major security shoe falls and triggers a large liquidation event, we could see sharp, violently amplified price swings tearing right through those thin order books. The defense is holding for now, for sure, but the structure beneath it is incredibly fragile. The longer we grind sideways with high leverage and low volume, the more explosive the eventual breakout or breakdown is going to be. As we wrap up this explainer, I want to leave you with a rather provocative thought regarding that $116 million Coldcard exploit we started with. The source material poignantly notes, hardware wallets exist because software wallets get phished and infected. Coldcard's pitch was that a dedicated offline device would keep the key material outside that mess. Here, the weak point was the key material itself. It really shatters the illusion of absolute safety in cold storage, doesn't it? So, the huge question you have to ask yourself as we watch this market standoff is this: what happens to the broader market's confidence when the ultimate defense fails? Thank you so much for joining me for this explainer. Make sure to double-check your security, keep an eye on those support levels, and stay safe out there.